We're joined for Instant Audit here by Ron Davari. He's the CEO of NewOak Capital. And Ron, great to see you this morning.
Good morning.
As we hear this healthcare reform rumble around in Washington, what do you think investors really need to pay attention to?
Well, I think the key element here is to see whether, how does that change the budget picture at the end of the day? Does that make the government debt to keep going up? And a lot of people do believe that despite the fact that they're saying that you're not going to incur a lot of changes in the spending, that the public doesn't believe that. The investors don't believe that.
Have you adjusted any of your strategy at NewOak because of what's going on, this kind of rhetoric that's happening down in
No, I think this is too chaotic. As you can see, they're even having a hard time to pass. And it's very difficult to really plan against something that hasn't really gelled in, and there's no real plan out there.
You know, we're going to talk about the G20 in a moment also, and that brings into this larger debate and question about government spending, and as the president talked about yesterday in those interviews that he did do, is just this government role and the debate about how much of a role government is going to have. You're saying investors don't believe, public doesn't believe that the deficit is going to go up. So you're not buying any of this argument. This healthcare thing is deficit neutral. You just don't buy it.
Oh, I won't buy it. Nobody else does. I think we have seen it before because. You know, first of all, there is no real solid plan out there for people to evaluate what this all means. And, you know, at the end of the day, I don't think you want to get your kidney changed at the post office. So that's a very big problem. I think the investors are finding that you know, you got to let these things to ultimately fall in the hands of the private sector, but we have to put in measures to make sure that the private sector is going the right direction, and we haven't seen that yet.
We're touching on something really important, is the fact that we continue to talk about this bill, but there is no bill.
There's no bill.
There's nothing really yet. So in the meantime, as we mentioned at the top of the show, we've seen the market rally. There's some questions again this week, as we pose it every week, it seems, of whether or not this is sustainable. So what do you think, considering, again, all these different variables we just mentioned? You have healthcare, you have the G20 meeting. What does it mean for the market this week?
I think that this is very important. We have seen a rally that is historically something we have only seen 6 times in the past. And it's very early in the game. You know, it's not 3 years into recovery. It's actually only a few months, and we haven't seen even really a positive GDP. So many people are questioning whether this is really caused by the liquidity that's pumped into the market, whether we really are bringing back the greed, and the greed is trying to drive this. Oh, I really think we're ahead of the game here. We need to have some, you know, healthy corrections, and we are going to see more data. Obviously, everything has been pointing positive. That's good, but again, we can't really go back and believe that we're back in 2006 and 2007. We need to really digest how the growth is going to work out. And G20 has really identified the fact that there is going to be a rebalancing going on globally, which American economy has to adjust to, and I don't think that's really yet settled in.
Right. Okay, we're going to talk about that right now, as a matter of fact. Ron, thanks. Ron Davari be with us all morning from NewOak, and ahead of that, all right, Instant Audit this morning. NewOak Capital CEO Ron Davari is with us. Ron, we were talking earlier about the markets. You made this brief reference that we haven't seen a rally like this off the lows very often, and there have been 6 in 100 years. They've all been in the 30s and the 70s. It seems like everybody wrote an article about it this weekend, so you had enough time to read about it. But what does it tell you? That it's about to give up the gains, or no?
I think what's so different this time is the amount of liquidity, global liquidity, that has been put in the marketplace. It's just incredible how much, and it's been very well coordinated around the world, and that liquidity has to go somewhere. It's not going to go into greenback, you know, yielding at you know, about 0.7, 0.8% yield. You know, after tax, there's really nothing left. So people are not going to keep their money in cash. They're going to do something, and with a rallying market, it feeds into itself that you got to take risks. You got to, you know, you don't want to be left at the punch bowl with your glass empty.
But is that real liquidity, or are you talking about the different liquidity put in by central banks around the world?
Yeah, that's what I'm talking about.
Right, but so is that real liquidity? Because that's something that's been, like we were just talking about with the Federal Reserve, with their different policies and new programs put out because of the state of the
Right.
This is not natural liquidity in the market. This is forced liquidity.
Absolutely, and that's the problem. This is all artificial until we take the, we're all already thinking what happens when the punch bowl is taken away. Are we also going to end up with a big hangover?
That's when the party ends, right?
That's the party ends, and you know how that goes.
Normally nowhere good. It's really good.
That's right. It's usually a rough
Going
day
back
the
to
next
my
day.
college year.
It's a couple of days, right? Nice flashback. So what's it going to look like, I wonder? Because I mean, it's real to the extent that the markets have gone up. That the price is the price. I mean, it is what it is. It is what it is now. And then the question, that next question, we still don't know what it's. A, timetable, and B, the price action, what it's going to look like. How do you see it playing out?
I think the most important thing is that I remember that back in 2006 or 7, there were phony stocks, meaning that people knew that there is no company behind it and they were trading up. So we're back into that point where if people they're only thinking what happens when I sell it, not what happens to the company or what happens to the position that I have. As long as it's self-feeding, and the Fed knows that. They're trying to talk up everything. The positive news is definitely amplified in their.
Well, they're just hoping the actual demand comes back at some point. They know what they're doing.
You need the psychology. The psychology is very important.
But you don't think it will?
I think at some point what happens is that when you have the herd mentality, when the first group of people leave and say, okay, it's time to dump, and that normally happens around October, November, when the year end ends, you want to essentially solidly lock your profits because the bonus is obviously dependent on that. So that's when we're going to know whether these guys are real risk takers or they were just in and out. And when the outs happen, then we will see that the momentum change.
Okay. Good enough. Watch that end of the year. Profit taking.
Yeah, that's
the end of the year.
We're just about there.
Because you want to have those nice yearly gains, right? Those look good.
We all need Christmas gifts.
Very good
point.
Ron, telling us about the Wall Street game. Ashley Webster, who,
Well, 3 CEOs present very different outlooks on the economy. The chief executives for FedEx, Cisco, and Office Depot sounded off on Fox News Sunday with Chris Wallace. Here now to talk more about this is our very own CEO, Ron DeVary of NewOak Capital. So, Ron, of those 3 different opinions, who do you agree with more?
Well, I think they're all right in one way or another. I think we have seen sequential growth, but off the bottom. And those things tend to be somewhat unstable until we really see a real liquidity back to the market. Earlier in the hour we talked about whether this is artificial liquidity or real liquidity. I think banks are not necessarily lending to small businesses.
Does that put a cap on the recovery then?
Oh, it sure does. If you're not, that's the lifeblood of our economy, the small business. Those guys have to get liquidity. Obviously, last week was an incredible week for the bond market. We had the largest amount of bond issuance from the corporations, which is, if you're a corporate trader right now, you think you're back in the heydays in terms of.
Are you jumping in on that over at NewOak? Do you guys like that?
Well, I think it's important. I think the companies used to get their liquidity from, the leveraged loans, and leveraged loan business has gone away because the larger banks are not lending. So they say, well, we'll go ahead in the public market. You're seeing both in Europe and the U.S. Quite a bit of issuance of bonds for companies, and that's a good sign that there is actually a good market, and actually the spreads are very tight.
Well, let's listen to what the CEOs have to say about the outlook, where they think the economy is actually headed.
I think the economy a year out will be growing between 2 to 4%. I think you'll start to see the unemployment pick back up. But Chris, the real sustainability of this is based upon have we thought 3 to 5 years out about how competitive our business is.
I think we need to get the liquidity to the small businesses to start to create jobs. If we do that, we will have a slow, steady recovery.
I think in the fourth quarter of this year, the economy is going to grow over 4% sequentially. Next year, our forecast is for between 2.5% to 3%. But remember, that's off a lower base that's come down because of the tremendous economic contraction we've had.
That's a good reminder there by Fred Smith. I only have about 30 seconds here, but what stands out to you about those comments?
I think it's irrelevant whether we have 2 or 4% in the next 2 quarters. The question is how fragile that recovery is going to be. The question is, are we going to be growing at a 3-4% steady for the next 5 years, which that would be 4 would be very high on the high side. If we achieve around 2% steady for the next 5 years, then it's a good thing. But the question remains whether we have really provided the liquidity to the small businesses to get and achieve those growths.
Okay, Ron, thank you very much for that perspective as well. And we'll be